Welcome to Talk Tickers. You are tuning into the premier earnings call summarization program strictly designed for experienced investors, portfolio managers, and market analysts who need to cut through the noise.
Absolutely. We are skipping the surface level narratives today.
Right. We are getting straight to the tape, analyzing the Q4 2025 earnings call of Core Scientific, which just wrapped up on March 2, 2026. What you are tracking here is a real-time, high-stakes, structural pivot.
Yeah, you are watching a company attempting to transition entirely away from a legacy Bitcoin mining operation, which we all know is subject to extreme volatility.
Put it mildly.
Right. And they were trying to rebuild themselves into a highly contracted, high-density AI and high-performance computing infrastructure powerhouse.
Which is arguably one of the most complex maneuvers a management team can attempt in public markets.
I mean, on one side of the ledger, you have a company actively executing one of the largest physical AI infrastructure build-outs globally. They're pouring billions of dollars into dirt, steel, substations.
But on the other side, the market's immediate reaction in the after-hours trading session was, well, decidedly cautious. We watched the stock slide about 4.5%.
Yeah, it was soft.
So what we are going to do today is unpack the exact anatomy of that disconnect. We want to show you the multi-year macro storyline of these gigawatt-scale power pipelines and contrast it directly with the near-term financial print that had the algos hitting the sell button.
Right, because at first glance, the market clearly didn't like what it saw.
Exactly. So let's start with that top-line print. Walk us through the Q4 financial miss. How much of this is the legacy mining business dragging down the metrics, and how much is friction in the new colocation pivot?
Well, the headline miss was stark. It gave the algorithmic traders plenty of ammunition right out of the gate. Revenue for the fourth quarter came in at $79.8 million.
Which completely missed the street.
By a wide margin. Consensus estimates were sitting up at $90.4 million. So you're looking at an 11.8% miss against expectations.
And a pretty significant drop year over year, right?
Yeah, a 15.9% drop from the $94.9 million they reported in the prior year period. And moving down to the bottom line, it didn't get much better for the algorithms. The non-GAAP adjusted earnings per share printed at negative 29 cents.
Missing the street's estimate of negative 27 cents.
Exactly.
Yeah.
And adjusted EBITDA swung violently into negative territory, hitting negative $42.7 million.
Wow.
Which is a massive contrast to the positive $13.3 million they generated in the same quarter last year.
Look, when you see a year-over-year revenue drop of nearly 16% during what is supposedly an AI infrastructure supercycle, it naturally raises red flags.
It absolutely does.
But if we break down the segment reporting, the mix shift tells a much more nuanced story. The legacy self-mining revenue plummeted to $42.2 million.
Down from roughly $80 million year over year.
Right. Meanwhile, the colocation revenue, which is the entire thesis of holding this stock right now, surged to $31.3 million.
Up from just $8.5 million a year ago.
So you have the old business aggressively scaling down and the new business ramping up, but the timing is mismatched.
That's the crux of it. The new AI colocation revenue simply hasn't reached the critical mass necessary to offset the cratering crypto revenue.
And that timing mismatch is the root cause of the EBITDA contraction.
Yeah, you have an organization carrying the massive overhead and capex burden of a hypergrowth infrastructure developer, but their current CAC-lowing asset base is shrinking.
Before we move off the financials, we have to highlight a massive anomaly on the GAAP reporting line.
Oh, the net income print, yeah.
Right, because this might confuse anyone running a quick stock screen. If you just pulled the GAAP net income, you would see a highly positive print of $216.0 million.
Which looks insane.
Right. For a company that missed heavily on operational revenue and EPS, printing over $200 million in GAAP net income looks like a typo, especially compared to the negative $291 million from the prior year.
And that is where reading the footnotes is critical for you as an investor. That $216 million figure is almost entirely a mirage.
It's driven by a $330.3 million non-cash fair value gain. Correct.
Exactly. It's a pure accounting mechanic, likely tied to the revaluation of warrants or digital asset holdings on the balance sheet at quarter end. It completely masks the actual operational cash burn.
So as an analyst, you strip that out immediately to see the underlying run rate.
You have to. Which brings us to the options market setup heading into the call. The positioning here was actually fascinating.
Volatility traders were pricing in a massive move, weren't they?
Huge. They were pricing in a 16.4% implied move by the close on March 2nd. And the activity wasn't neutral. It was heavily skewed toward calls at an 8-to-3 ratio.
So the street was positioned for a major breakout.
Yeah, likely anticipating a surprise hyperscaler contract announcement. Instead, from the pre-call period through the first 30 minutes of the broadcast, we just saw a steady bleed. The stock dropped from the 16.49 close down to around 15.75.
It's the definition of a show-me-the-money market reaction.
Exactly. Investors weighed these massive long-term pipeline promises against the immediate revenue gaps and just decided to wait on the sidelines.
Well, let's transition to the physical reality of the build-out, because this is where the disconnect between the stock price and the operational execution becomes glaring.
It really is a tale of two realities.
Management spent a significant portion of the call detailing their 590 megawatt commitment to CoreWeave. And the physical metrics from 2025 alone are staggering.
Staggering is the right word. We are talking about building out 1 million square feet of data center shell and installing $2 billion worth of infrastructure in a single calendar year.
They logged more than 5 million labor hours.
With an average of 3,300 workers on site across their various campuses, the total project investment here is eclipsing $5 billion.
Look, the sheer logistics of moving that much steel, concrete, and high-voltage equipment into rural deployment zones in a 12-month window, it's a monumental feat of supply chain management.
It is. But this brings us back to the core question you have to ask as an investor. If they are successfully executing one of the largest physical deployments in the world, why did they miss revenue?
Right, and the answer lies in the operational lag.
Exactly. Management stated they currently have roughly 350 megawatts of capacity energized.
I love the phrase they used on the call for that. They described it as hydrating all the equipment with electrons.
It's a great visual, but here's the catch. Out of that 350 energized megawatts, only close to 200 megawatts are actively billing.
Okay, so stop right there. If they have 350 megawatts hydrated with electrons, the natural assumption is that revenue should be following immediately.
Right, you flip the switch, you start the meter.
But a 150 megawatt gap between energized capacity and billing capacity implies severe friction somewhere in the system. What exactly is the bottleneck happening between turning on the power and cashing the check?
It is the commissioning window. And the market routinely misprices how complex this phase is. In a modern AI data center, when the utility delivers power to the substation, you do not just plug in the servers and start billing.
It's not a desk lamp.
No, not at all. Every single data hall has to undergo a rigorous multi-stage commissioning process before the tenant will actually accept the facility.
What does that process look like in practice?
You start with level 1 through level 3 commissioning. That's mostly factory acceptance and visual inspections, just making sure the gear arrived intact. But level 4 and level 5 are where the friction lives.
Integrated systems testing.
Exactly. You are running massive electrical load banks to simulate the heat generation of tens of thousands of GPUs. You are stress testing the primary power, simulating grid failures to ensure the backup generators and UPS systems catch the load within milliseconds.
And with the transition to direct-to-chip liquid cooling, you aren't just testing air handlers anymore.
Oh, not even close. You are testing complex fluid dynamics, secondary cooling loops, specialized heat exchangers. If there's a pressure drop or a microscopic leak in the manifold, an entire rack of multi-million-dollar GPUs is compromised.
Which is exactly the risk the commissioning phase is designed to mitigate.
Exactly. Management explicitly noted that this natural lag between energizing the facility and commencing billing is generally a 90-day window.
So a full quarter.
Right. It can vary slightly based on specific site anomalies or unique customer network requirements, but 90 days is the baseline.
So if you are building out your financial models, you must factor in a full quarter delay between the capex of getting a site live and the realization of that colocation revenue.
And that 90-day lag is exactly where the earnings mislived this quarter.
To really ground this scale for you, let's look at the geographic footprint. Take the Denton, Texas campus.
Massive site.
Yeah, this is a 262 megawatt, 400,000 square foot facility. By the end of Q4, they had delivered 67 billable megawatts across 3 buildings.
And if you fast forward to today, Denton North is fully operational. That represents 90 billable megawatts running production GPU workloads right now.
So in total, Denton alone currently represents approximately 130 billable megawatts, actively supporting more than 50,000 Grace Blackwell GPUs.
It's incredible. And moving east, you have Marble, North Carolina. This is a 65 megawatt, 250,000 square foot data center. They achieved full site energization in 2025.
2 of the 3 data halls were delivered by year-end, right?
Yeah, bringing 36 billable megawatts online to support roughly 15,000 Grace Blackwell GPUs. The third hall is currently grinding through that exact commissioning phase we just discussed.
Expected to deliver in the second quarter.
Right, and the customer is actively accelerating GPU deployments into that site right now.
And they are simultaneously juggling active sites in Muskogee, Oklahoma. Phase 1 there is a 70-megawatt facility, fully energized and moving into the Q2 commissioning window.
Plus Dalton, Georgia. Phase 1 there is preparing for high-density liquid-cooled systems, and vertical construction is already underway for Phase 2.
It is a massive juggling act of capital allocation.
But management was very clear on the call that Denton and Marble are just the tip of the spear.
Right. If you look past the 590-megawatt CoreWeave contract, they're staking their future valuation on a massive 1.5 gigawatt leasable pipeline.
Now, in this market, whenever a company claims gigawatt scale, you have to look for the receipts.
You do. Do they actually have the land, the power rights, and the regulatory clearance? Because skepticism is absolutely warranted here.
Yeah, the market is flooded right now with companies claiming massive power pipelines based on speculative load studies that will frankly never see a physical transformer.
But management attacked this skepticism aggressively on the call. The crown jewel of their forward pipeline is the newly announced Hunt County, Texas site.
Let's talk about Hunt County. We're talking about 265 acres, situated about 45 miles outside the Dallas-Fort Worth metro area.
They project this site can support roughly 430 megawatts of gross power capacity,
which nets out to about 285 megawatts of customer leasable capacity. And they expect to officially close on this site by the end of Q1.
What really stood out about the Hunt County site was the regulatory nuance management highlighted. For those of you tracking the Texas grid, ERCOT has become a massive bottleneck.
It's a nightmare for new developers.
But they specifically noted that the Hunt County site is immune to the recent ERCOT Senate Bill 6 restudy risks. Break down why that immunity is such a critical competitive advantage.
Okay, so for anyone not deep in the weeds of Texas energy policy, ERCOT is currently clamping down hard on new, large-scale flexible loads.
Which predominantly means crypto miners and data centers.
Exactly. Senate Bill 6 essentially created a framework that forces proposed projects into a prolonged restudy phase. They have to assess the impact on grid stability and transmission infrastructure.
And this restudy process can delay a project's energization timeline by years, right?
Easily years. But because the Hunt County site had its energization schedule approved back in 2024, it is grandfathered in. It bypasses this multi-year regulatory traffic jam entirely.
Wow.
So in an environment where power certainty is the ultimate premium for hyperscalers, having a greenlit, risk-free ERCOT schedule for nearly 300 leasable megawatts near a major hub like Dallas, it's a massive, highly monetizable asset.
You combine that 2027 to 2029 Hunt County timeline with what they're doing in Pecos, Texas.
Pecos is fascinating.
It is. It's a planned 200 leasable megawatt campus in West Texas. But the transition dynamic here is what makes it unique. They are actively converting this site from legacy Bitcoin mining into a colocation asset.
Early civil work and engineering are already underway.
Right. And management noted this site is hitting what they call the Goldilocks zone, meaning they have secured the general contractor, locked in the long lead supply chain equipment, and established a timeline to be ready for service, or RFS, within 12 months.
That 12-month RFS window is the holy grail right now.
Because hyperscalers are in an arms race for compute.
Exactly. And their deployment schedules are heavily compressed. They cannot afford to wait 36 months for a greenfield site to clear environmental permits and substation construction.
Right. So by having Pecos ready within a year, the company commands incredible pricing leverage in lease negotiations.
Absolutely.
But having the power and the 12-month timeline is only half the battle. You have to actually secure the tenants.
And that brings us to the forward observer strategy.
Right. Management detailed this strategy where essentially they are spending hundreds of millions of dollars in capital to advance development across these pipeline sites.
Doing the civil engineering, preparing the grounds.
And crucially, writing the checks to secure long-lead supply chain equipment like high-voltage transformers and cooling infrastructure long before they ever sign a tenant to a lease.
Now, to a traditional commercial real estate or infrastructure investor, deploying massive capital without a signed tenant feels reckless.
It violates the core tenets of risk mitigation.
It does. But in the current high-performance computing landscape, time is a far more valuable currency than capital efficiency. Management views time to RFS as the ultimate trump card.
By progressing these sites to an advanced state of readiness at their own risk, they offer customers a high degree of certainty around delivery timelines.
Exactly. When an AI company needs capacity, they're going to sign with the developer who already owns the transformers, not the one who just filed a permit application.
The strategy makes logical sense. But we have to address the major point of friction on this call.
The missed customer announcement.
Yes. Management explicitly acknowledged that they missed their own stated target. On a prior update, they established a goal to announce at least one new customer contract by this Q4 earnings call.
And they failed to deliver that.
The CEO was direct, stating they were not satisfied with that. But he heavily emphasized that this is a timing issue caused by complex negotiations, not a lack of demand.
Right.
If the demand is truly so robust, why are these contracts stalling at the finish line?
The delays are stemming from two distinct shifts in the customer negotiation landscape. First, regarding the massive hyperscalers. The company was previously operating under a merger agreement.
Right, and during that period, hyperscalers simply paused negotiations.
Because institutional giants will not engage deeply with a vendor undergoing a major corporate restructuring. The counterparty risk is just too high.
But now that the merger agreement has been terminated, those talks have resumed.
They have. The company currently has 500 megawatts under short exclusivity arrangements with a large investment-grade counterparty. But look, these are rigorous institutional processes. Structuring a 15-year lease for a gigawatt-scaled campus takes armies of lawyers. It doesn't happen overnight.
But the second dynamic is arguably more systemic across the industry. It involves the neocloud market.
The neocloud dilemma.
Yes. For those listening, neoclouds are the specialized secondary cloud providers who have sprung up to focus entirely on AI workloads. There is massive, insatiable demand from these players.
But management is drawing a hard line in the sand. They're demanding investment-grade guarantees before signing any deals with neoclouds.
And this dilemma is single-handedly slowing down deal velocity across the entire data center industry.
Think about it. Imagine a neocloud backed by a few billion in venture capital wants to lease 100 megawatts. The infrastructure provider is looking at a 15-year commitment that requires massive upfront capital expenditure. They are saying, venture capital funding can dry up in 18 months. We need a strong, permanent balance sheet standing behind this contract.
So in practice, what does that actually look like? How does a startup neocloud provide an investment-grade guarantee?
It requires a highly complex, multi-party financial structure. The neocloud has to secure a guarantee from a major chip maker, often NVIDIA itself, or a legacy hyperscaler, or they have to go out and buy a massive insurance wrap from a major investment-grade financial institution.
And putting that structure in place requires exhaustive due diligence from everyone involved.
Exhaustive. The chip maker has to underwrite the neocloud's business model, the debt wrapper has to underwrite the chip maker, the infrastructure provider has to underwrite all of them.
These are novel, untested financial structures in the commercial real estate space.
And negotiating the covenants and default provisions takes months of legal grinding.
Management made it abundantly clear that they will not compromise on counterparty strength just to announce a flashy headline.
Which is the right move. They are protecting the long-term downside over the life of these 10 to 15-year contracts.
They are willing to endure the short-term pain of a delayed customer announcement and a 4.5% stock slide if it means securing a fortress balance sheet on the other side of the trade.
And if you are an experienced investor holding the stock for the next 5 years, that is exactly the discipline you want to see. You do not want a multi-billion-dollar physical asset secured by a startup that might go bankrupt during the next AI hardware cycle.
No, you want it backstopped by sovereign-level tech balance sheets.
Exactly.
Speaking of the hardware cycle, let's pivot to the physical reality inside these buildings, because the engineering hurdles management described are immense.
The COO gave a rundown of how they are actively redesigning data halls mid-flight.
When they broke ground on the first CoreWeave facilities, the industry standard was NVIDIA H100s.
But the life cycle of that architecture is moving so fast, it is almost impossible for physical construction to keep up.
From H100s, they had to rapidly adapt to accommodate NVIDIA's Grace Blackwell NVL36 architectures.
Then the industry pushed to NVL72s.
Now they're moving from GB200 platforms into GP300 platforms.
And during this call, management noted they are already preparing the site blueprints for NVIDIA's upcoming Rubin Vera chipsets.
Furthermore, they aren't just locking into the NVIDIA ecosystem. They're actively evaluating how to adapt their standardized data halls to accommodate Google TPUs as those proprietary chips become more prevalent in multi-tenant environments.
The implication for the physical infrastructure is massive. Every time that chipset evolves, the power density requirements and the thermal management paradigms fundamentally shift.
We're talking about moving from traditional forced air cooling in the H100 generation to complex direct-to-chip liquid cooling manifolds and eventually to entirely new immersion or advanced thermal loop systems.
The engineering teams are quite literally redesigning the primary power distribution pathways and the secondary cooling loops while the concrete is curing on the foundations.
It completely exposes the obsolescence of legacy data centers.
Oh, totally. A traditional enterprise facility built 5 years ago might pull 10 to 15 kilowatts of power per rack.
Right.
These new Grace Blackwell architectures are pushing 100, 120, even 150 kilowatts per rack.
You cannot retrofit a 15-year-old building to handle a 10x increase in power density and the corresponding heat generation.
No, you have to build purpose-built AI factories from the ground up, which validates their massive capital expenditure program.
Management also highlighted a really interesting strategic divergence in how they handle different AI workloads, specifically contrasting large language model training with inference.
Yeah, they spent some time discussing their Auburn, Alabama site.
This is a 30-megawatt multi-tenant Tier 3 facility, and it stands out as an outlier in their portfolio.
Auburn is a fascinating strategic asset. While the Denton and Hunt County campuses are massive, gigawatt-scale behemoths built out in rural areas specifically for monolithic LLM training clusters.
Auburn is designed for a completely different phase of the AI lifecycle.
Exactly. It features highly dense network connectivity, multiple smaller 10,000-square-foot data halls, stringent security protocols, and a carrier-neutral environment.
It functions much more like a modern Equinix interconnection hub than a raw compute farm.
And management positioned Auburn as their prime entry point for capturing enterprise AI inferencing workloads.
The distinction between training and inference is critical for infrastructure pricing.
Training a massive LLM requires raw, centralized compute power. It can sit in rural Texas because the latency to the end user doesn't matter when you are just crunching data for 6 months.
But inference, which is the process of the model actually answering a user's prompt or running a live real-time enterprise application, is highly sensitive to latency.
Right. It requires geographic proximity to the end user and dense fiber connectivity.
By operating a 30-megawatt Tier 3 site in Auburn, they can capture that highly profitable, low-latency enterprise inference demand while dedicating the massive Texas sites entirely to raw training power.
It creates a diversified revenue stream within the colocation business itself.
But while all this future-facing AI infrastructure is consuming the narrative, we have to look at how they are managing the legacy business.
The Bitcoin mining fleet is officially in a state of managed runoff.
Management's tone was unambiguous. They are no longer treating crypto mining as a core growth pillar or investing fresh capital into upgrading the hash rate.
The unit economics post the April 2024 halving practically dictate this strategy.
The majority of their mining machines are 4 to 5 years old. Running older generation, inefficient rigs when the block reward has been slashed in half is a low margin, and in many power markets, a negative margin endeavor.
They explicitly stated that they are currently only spinning these machines to cover the contractual minimum power draw requirements at certain sites.
Just keeping the lights on while those specific sites await their scheduled conversion to colocation.
Basically, they are essentially using the legacy mining fleet as a placeholder to hold onto their valuable grid interconnection rights.
But they are still demonstrating shrewd treasury management with the assets they have left.
The Bitcoin sale, yeah.
In January, capturing the market highs, the company executed an opportunistic block sale, liquidating just over 1,900 Bitcoin.
That generated approximately $175 million in raw liquidity.
And following that transaction, they currently retain fewer than 1,000 Bitcoin on the balance sheet.
Which confirms the underlying narrative. They are aggressively monetizing the highly volatile crypto assets to fund the predictable, contracted, capital-intensive infrastructure build-out.
Now, we need to address the accounting issue that almost certainly triggered the algorithmic selling we saw in the after-hours session.
Right, the restatement.
In early 2025, the company transitioned its auditor from Markham to KPMG. During KPMG's standard transition audit procedures, specifically reviewing the legacy mining sites being converted to colocation, they identified a historical accounting error going back to 2024.
The issue centers strictly around property, plant, and equipment, or PP&E accounting rules.
Walk us through what actually happened.
When the company was actively demolishing legacy mining infrastructure, tearing down old racking and cooling structures to clear the concrete pads for the new high-density colocation builds, the historical accounting treatment capitalized those demolition costs.
And maintained the existing carrying values of the demolished assets on the balance sheet.
Exactly. KPMG reviewed this and determined that those carrying values and demolition expenses should have been written off immediately in the historical periods in which they occurred, rather than capitalized into the new project costs.
For anyone building a discounted cash flow model or evaluating the company's liquidity, pay very close attention to this next point.
It's critical.
Management explicitly stated, and KPMG confirmed, that this restatement has zero impact on revenue, zero impact on adjusted EBITDA, and zero impact on net cash flow.
It is purely a non-cash historical balance sheet correction.
However, because the restatement occurred, the company is legally required to carry a material weakness flag in its SEC filings for the next 4 quarters.
And in modern market structures, that phrasing is toxic.
Oh, absolutely.
The majority of after-hours trading is driven by quantitative funds and automated algorithms that scan SEC filings in milliseconds.
When an NLP algorithm reads the phrase restatement, combined with material weakness on an earnings release, it triggers automatic, indiscriminate risk-off selling protocols.
That headline risk obscured the massive operational milestones achieved during the quarter and contributed heavily to the stock sliding 4.5%.
But for the fundamental investor who takes the time to read the footnotes, as the CFO stressed, it does not alter the underlying cash generation profile, the balance sheet liquidity, or the trajectory of the CoreWeave contract in any way.
Let's pull all of this together and look at the broader macro setup for you, the investor.
What we are witnessing is a stock locked in a fundamental structural tug-of-war.
The management team is fighting tooth and nail to shed its minor beta.
They desperately want to decouple the stock from the price of Bitcoin and the volatility of global hash rates.
Right, and re-rate to the premium double-digit EBITDA multiples afforded to pure-play, blue-chip AI infrastructure operators like Digital Realty or Equinix.
But the market is stubbornly applying a heavy discount to that 1.5 gigawatt forward pipeline.
Institutional investors are looking at the presentation and saying, we see the land acquisitions, we see the ERCOT power approvals, but until we see concrete billing revenue visibility and signed diversified contracts from investment-grade tenants beyond the initial CoreWeave deal, we are not going to award you that premium infrastructure multiple.
The market is demanding flawless execution before it awards the re-rating.
Fortunately for the company, while they wait for the market to catch up, their capital formation and liquidity position is a fortress.
They ended the quarter with $533.4 million in total liquidity,
which is comprised of $311.4 million in hard cash and roughly $222 million in retained Bitcoin,
giving them immense runway to execute the forward observer strategy without needing dilutive equity raises.
But the real financial lever here, the engine that will drive the 1.5 gigawatt pipeline, is the project financing dynamics.
The CFO outlined a massive capital pathway.
Yeah, upon stabilization of the initial 590 megawatt CoreWeave contract, the company has up to $4 billion in project-based financing available to draw against that contracted capacity.
Because they're progressing so rapidly on the physical billing milestones, they expect to unlock the vast majority of that $4 billion availability before the end of this current year.
And this touches on a broader industry trend they highlighted regarding how these mega campuses are funded.
For the upcoming pipeline sites, they are targeting project-based financing structures with advance rates ranging from 60 to 85% on total build costs.
But here is the critical catch. Unlocking those high 80+% advance rates from major infrastructure banks is entirely dependent on the credit quality of the end tenant.
This circles right back to the NeoCloud dilemma we discussed earlier and why management is willing to delay customer announcements to hold out for investment-grade guarantees.
You cannot walk into a major Wall Street infrastructure bank and ask for an 85% advance rate on a $500 million rural Texas campus if your only tenant is a Series B startup.
The bank will laugh you out of the room.
You need NVIDIA, Google, Microsoft, or an investment-grade debt wrapper co-signing that lease. The credit quality of the tenant literally dictates the cost and availability of the developer's construction capital.
So the macro takeaway for you, the investor trying to navigate this space, is this. The bottleneck in the AI revolution is no longer just securing power.
Everyone in the financial media talks endlessly about grid constraints and nuclear power restarts.
But the real immediate constraint is execution and capital structuring.
The winners in this space over the next 36 months will be the operators who not only have existing grid interconnection rights and secured high-voltage transformers in hand, but who possess the heavy, gritty construction expertise, the supply chain mastery, and the institutional patience to navigate these highly complex, multi-party investment-grade financing structures.
It is entirely about translating abstract electrons into tangible, recurring revenue.
And right now, the market is mispricing the friction and the timeline of that translation.
All right, we've broken down the financials, the engineering constraints, and the pipeline dynamics. Now let's put it into practice.
The fun part.
If we're sitting at a trading desk right now trying to monetize this structural pivot, and keeping in mind this is strictly a hypothetical exercise, not financial advice, how do we trade this dislocation?
If I'm pitching this to an investment committee today, I'm putting on a highly structured pairs trade. Let's call it the Forward Observer Arbitrage Straddle. We are going to aggressively capitalize on the massive dislocation between the RFS premium ready for service and the legacy crypto discount.
Break down the mechanics for us. Let's start with the long leg of the trade.
For the long leg, you go long, deep, out of the money 2027 EAP call options on this specific infrastructure operator. The thesis here is simple time arbitrage.
The market is currently punishing the stock for a 90-day accounting lag on-site commissioning and a temporary pause in tenant signatures while the hyperscalers restructure their guarantee frameworks.
Exactly. The market sees a temporary revenue miss today. What we see is mid-2026.
By mid-2026, that $4 billion project financing facility fully unlocks.
And those 500 megawatts currently sitting under short-term exclusivity agreements will inevitably convert into guaranteed hyperscaler contracts at absolute peak market lease rates.
When that catalyst hits, this stock will violently re-rate from a depressed legacy crypto miner multiple to a premium Equinix or digital realty infrastructure multiple.
You want to own the upside convexity of those LEPs before the broader market realizes the entire forward pipeline is fully funded and de-risked.
But playing long options on a former crypto miner carries immense inherent volatility. How are you hedging the general equity beta to isolate just the execution alpha?
That is where the short leg comes in. To isolate the pure AI infrastructure execution, we're going to short a basket of pure play, mid-cap Bitcoin miners.
Specifically, we actively target the miners who do not have funded infrastructure pivots.
We are looking for the operators who are currently bleeding out to the punishing unit economics of the April 2024 halving, running ancient, inefficient, air-cooled fleets.
Crucially, we target the miners whose heavily promoted AI load studies are nothing more than speculative paper presentations.
Right. They have no real grid interconnection agreements, no secured transformers, and absolutely no heavy construction expertise.
As the year grinds on, the market will separate the actual physical builders from the speculative pretenders, and those pure-play underfunded miners will face massive multiple compression.
I love the mechanics of pairing the actual builder against the paper tigers.
But we are not stopping there. Let's add a kicker to this straddle. I would pitch a synthetic short on commercial urban real estate REITs that focus heavily on legacy enterprise data centers.
The rationale here relies on what you call the ghost town AI conversion.
Explain the thesis on targeting urban real estate. Why go after legacy data centers?
Look at the 30 megawatt tier 3 inference setup in Auburn, Alabama we discussed earlier.
Right.
These dense, highly connected mid-size rural and suburban sites, originally designed for crypto, are rapidly converting into high-performance computing hubs.
They are going to steal the highly profitable, low-latency enterprise AI inferencing workloads right out from under the noses of the expensive, space-constrained, power-limited legacy urban data centers in places like downtown Chicago or Northern Virginia.
The future of enterprise tech isn't in a 15-year-old downtown high-rise. It's in rural crypto sites converting into state-of-the-art AI inference hubs featuring direct-to-chip liquid cooling.
You short the urban legacy footprint to fund the rural AI expansion.
It's an incredibly aggressive posture, but the underlying mechanics are structurally sound. You are long the execution reality of massive capital deployment, short the crypto fantasy of speculative load studies, and short the legacy infrastructure obsolescence.
Okay, stepping out of the trading desk persona, let's recap the core tension we've unpacked for you today.
You have a genuinely messy quarter financially.
It is bogged down by non-cash accounting restatements, a structural 90-day revenue lag on commissioning, and shifting customer negotiation timelines that spook the algorithms.
Yet, juxtaposed entirely against that messy print, you have arguably the most successful physical deployment of AI infrastructure occurring anywhere in the world right now.
Boasting 1 million square feet built, 350 megawatts energized, and a fully funded grid-approved runway to 1.5 gigawatts.
It is a phenomenal case study in the friction between short-term market mechanics and long-term physical reality.
And I want to leave you with one final provocative thought to mull over as you analyze this sector.
We spent a significant amount of time discussing the neocloud dilemma and the stringent demand for investment-grade guarantees.
If legacy hyperscalers and megacap chip makers are the only entities capable of providing the massive balance sheets required to fund these 15-year infrastructure buildouts, are we witnessing the end of the startup AI era?
It is a terrifying thought for market competition.
Exactly. If you need a $1 trillion market cap just to co-sign the lease on a next-generation data center, we may be watching the total irreversible monopolization of the physical layer of AI by just 3 or 4 mega-cap tech giants.
The software models might remain open source, but the concrete, the high-voltage transformers, and the raw power will be strictly oligopolistic.
An incredible point to end on, highlighting the massive barriers to entry forming in real time. As always, a mandatory reminder that the trade ideas discussed today are purely hypothetical intellectual exercises, and nothing heard on Talk Pickers should ever be construed as financial advice.
Investing involves significant risk, particularly in emerging capital-intensive sectors like AI infrastructure and digital assets.
We invite you to subscribe, leave a review, and most importantly, dive into the primary earnings materials yourself to conduct your own rigorous due diligence on the rapidly shifting dynamics of the AI physical layer. Thank you for listening to Talk Tickers. We will see you on the next tape.